I'm very confident that in 2026, we're likely to see a significant downturn in the market.
A year before the threat of war and declining job numbers, this Wall Street veteran predicted the exact date of the next market downturn.
And we've zeroed in on mid-March of 2026 as the likely time when the stock market will peak and perhaps head down into a first significant correction in over 2.5 years.
Now, just days away from that date, and the volatility in the market is showing signs we may be headed toward that prediction.
When you get into the second year of the presidential term, reality sets in because some of these changes are fairly dramatic.
Mark, so great to have you back on the show today, and the timing is really perfect. I know that we talked just last year about this time, and you gave us that exact date of the next market crash. It's one of our most popular videos on our channel, and lots of people watched this video and saw this prediction, and now we're here. The mid-March timeframe is what you talked about, and we're just about a week away from that. I kind of feel like what you talked about is starting to unfold. Is that what you're feeling?
I am, Bridget. And, Yogi Berra famously said predictions are difficult, particularly about the future. But this one looks like it's in the process of happening in real time.
Yeah, the initial prediction that you gave was based on the presidential election cycle. So I want to get into that. We're also going to talk about in this video kind of the current events happening right now, some other indicators you're watching that are leading you in the direction of anticipating a bear market and leaning in towards protecting your investments. I know you have 3 things that investors can do to protect their investments during a potential bear market that you are predicting to see yet this spring. So we're going to get into all of that in this video. But first, let's talk about that election cycle prediction that you had about the market crashing in mid-March timeframe. Why is that? Talk about that presidential election cycle a little bit and what we've seen in the past.
Well, we're in the second year of the presidential cycle. It's the midterm election year, and that is the weakest of the 4 years in the presidential cycle. On average, in the last 17 cycles, going back into the 1950s, the second year of presidential cycle in the S&P 500 has averaged a 1% gain. The other 3 years of the cycle have averaged double-digit gains. So the market was starting 2026 with a little bit of a weight tied around its ankle. And the period when the market typically peaks in the last 17 midterm election years, so that spans 4 times 17, 68 years, is in that mid-March to early April timeframe.
That is so fascinating to look back and see that historical data and see that kind of playing out right now. But I think you have some investors who are kind of on both ends of that spectrum. Some people say, oh no, the market bull run is going to continue. They look at the volatility we saw on Monday to start the week, and we saw that start out in the red pretty much across the entire market and then ending more in the green. What do you look at the volatility we saw yesterday? What is that an indicator of for you?
Well, first of all, the market is not necessarily trading on fundamentals. The market typically trades on expectations. And with the oil price spiking above $100 a barrel, the anticipation, the expectation is that the inflation rate will spike up, whereas it has been flattening out. So what that means is that the Fed normally would raise interest rates to combat rising inflation. But with the unemployment numbers from last Friday showing a loss of 92,000 jobs, the Fed would normally be cutting rates to help the job market. In essence, the Fed has its hands tied. So the market is trading very much on events and, sadly, our president's tweets. And this is a time when you have to put politics aside. And when I say sadly, because you can't anticipate a tweet. You don't know what someone's going to tweet in an hour. So last night, the president said the war is almost over. This morning, his Secretary of Defense said this is going to be the biggest bombing day of the war. So there's a lot of conflicting information, and none of it is verifiable. And the market is trading on that. The machines are trading on that. The machines don't make rational decisions. They just react to what they're programmed to do. So it's a volatile time, and it's a time to put your politics in the drawer. Just watch the market. Remember, Marty Zweig famously said, watch the Fed and listen to the market. Well, the Fed is basically in a straitjacket, in my opinion. It's almost like, well, we can't cut rates to help the labor market because the inflation rate is likely going to spike up. So it's a time to really pull back and assess what's going on in a very calm and rational way. And it has nothing to do with politics.
Yeah, you just gave examples of many different indicators that you're looking at right now that are outside of that presidential election cycle. I know that mid-March timeframe, the original prediction was based on historical data that we've seen in the market year after year in that 4-year election cycle. But you just gave, again, examples of many different outliers from that presidential election cycle. There's other factors at play here than just that presidential election cycle, but all of it is impacting the market and leading to more volatility. And I think it's great advice to continue to watch the market and just see how the market is reacting. But going back to that presidential election cycle that you talked about over a year ago here on our channel, you also said one indicator that you look at is the ARK fund and looking at that as a potential indicator for when that downturn might start to happen. Let's talk about that a little bit and why that's an indicator you've looked at in the past.
I'll be watching the ARK Innovation Fund and looking for cracks in the price structure there. But at some point, just as it did in 2021, I expect that we'll see a bearish rating on that. Well, we're talking about Cathie Wood's ARK Innovation Fund, which has always been a proxy for the speculative technology part of the stock market. Before I do that, let me emphasize that we are not yet in a bear market. We're not even close to it. A bear market is defined as 20% drop on a closing basis in the S&P 500. As of last night's close, we're only down 2%. And that's the problem for investors, because if you look at the Mag 7, where a lot of people have money, or if you're invested in the SPY or QQQ, you're very exposed to the Mag 7, which represents about a third of the market value in the S&P 500. Well, those stocks are in a steep downtrend. Some of them are in bear markets already. You've talked about Microsoft many times on the show. These stocks are not doing well. And the ARK Innovation Fund is a proxy for that. And guess what? That's down 28% from its high in October. So we have under the surface signs of deterioration. And we're not even in a correction. We define a correction as 10 to 20%. We define a pullback as 5 to 10%. On the surface, things look pretty darn good. And as you pointed out, a very volatile day on Monday, and the market finished on an up note. But under the surface, there's a lot of cracks, and that's what people have to be protecting against.
Yeah, such great advice for investors to be looking at what's under the surface and looking at those indicators that show now may be a time to look at protecting yourself. And I know that's exactly the advice you have for our viewers today, is looking at 3 ways to protect your investments if we do move the market into that full bear market. I know, I think like you said, many of the big stocks that so many retail investors are in are really in that bear market territory already, even though the full market picture might not be there quite yet. So we're going to get into those 3 areas of advice for investors. And all of this advice is easy to find with the Chaikin Power Gauge. I know that's how you are looking and evaluating stocks. If you want to learn more about Mark's Power Gauge system and how it can help your investments and how to help yourself stay protected during any volatility that may be ahead in the weeks and months this year, make sure to scan the QR code or click the link we have in the description of this video. It's a great way to check out Mark's Power Gauge program. Mark, let's get into that advice for our viewers today. What's the first way that you can look at protecting yourself or at least hedging your investments against any bear market trend that might be coming?
Well, the first thing people should do is sell down to the sleeping level. And what that means is raise enough cash that if the market does go into a correction, which is 10 to 20% down, or a full-blown bear market, that you don't panic at the bottom because you can't deal with the pressure. So never invest more than you can afford to lose. And in this case, raise cash. And for most people, that would be between 15 and 25% of their portfolio. You certainly don't want to sell everything because we don't know what's going to happen, 6 months, 4 months, or even 2 months from now. All we can do is hedge against a worst case scenario. If the market holds up, you can redeploy that cash very quickly. If it doesn't, you'll be very happy that you're sitting on a lot of dry powder.
Yeah, I think that's excellent advice and something we hear from investors who, whenever the market drops, they want to have cash on hand so they can take advantage of the downturn that we might see. And I know we saw that last year in April during the tariff situation. But let's talk a little bit. I think the next natural question that a retail investor would have is, well, what should I sell if I'm looking to raise cash and get out of some stocks that I'm currently in? Which sectors would you look at for raising cash first?
Well, that's a perfect segue into the fact that anything that has a bearish power gauge rating based on our 20 factor model should be sold. Remember, we're within 2% of the high. And if a stock has a bearish rating here, it's very vulnerable. Chances are it's already down 10 or 15% from its high. So the first thing you do is to prune the losers out of your portfolio and stick with the stocks with bullish power gauge ratings in healthcare, in aerospace and defense, in the energy sector. And that's where you gain an edge by focusing on strong stocks and strong industry groups and weeding out the stocks in tech and software, particularly, and in some of the more vulnerable areas of the market.
Solid advice for investors. I think right now we've done plenty of videos and heard plenty of advice from other people we've had on the show talking about buy the dip in software and that there's some software stocks, some tech stocks that are just oversold right now. And now is the time to be getting into those. The advice you're giving about sell the losers and don't be in any stock that's in a bearish rating on the power gauge seems to be opposite to that buy the dip mentality.
Buy the dip has worked for over a year. I don't think it's working right now. And in this kind of uncertain market environment, you don't go looking for bargains. You let the bargains find you. And that means not routinely buying the dip. But if you are going to put money to work, and I'd suggest that you do it more judiciously than if you're in a roaring bull market, is to look for stocks with bullish power gauge ratings. So, for instance, the infrastructure build out segment of the market is still very strong. You know, the companies that are building the data centers, providing the cooling systems, the copper wiring that's needed to move the data around quickly, that segment of the market is very strong like that, as well as the defensive stocks like pharmaceuticals and biotech. So there's plenty of stocks to buy. There are always good companies to buy. The question is timing. When do you buy them? And in uncertain times, you don't jump at the first buying opportunity. And as you've been pointing out, people have been bottom fishing in Microsoft for 3 months now, and it hasn't paid off. It may pay off long term. So, in uncertain times, it pays to let the bargains find you. You don't go bargain hunting or bottom fishing until the uncertainties start to clear up.
All very good advice. Let's move on to that next step of advice you have for investors whenever we're facing a potential bear market.
Well, you have to monitor the technical indicators. In this case, you're looking at the 200-day average, which is still it's around 67.75 on the S&P 500. It would represent only about a 7% drop from the peak, so not even in the 10% correction phase. So you got to watch the technicals because right now I'm bearish to cautious, waiting to see whether we get a correction in the market or whether we go into a full blown bear market. As I said earlier, if the 200-day average holds and the price of energy, price of oil drops because there's either a ceasefire or the opening up of the Straits of Hormuz, you can get back in the market very quickly using ETFs or buying your favorite stocks. But if we break down, if we break the 200-day average, which is closely watched by technical and fundamental investors, then you're going to be really happy that you're sitting on some cash.
Doubling down on the move to cash advice, it seems like one of the most important things in a potential bear market here for investors. I do want to talk about those technical indicators a little bit more and looking at other indicators that you're watching in the market. I know this week we have all kinds of different economic data coming out. We have new information being released this week. Are those indicators that you're also following closely for signs of that potential market downturn or bearish market?
Well, I don't think that the fundamental indicators mean very much in a wartime and in a time when, as I said, tweets are driving the market, not fundamentals. We do have a gauge called VIX, which is the volatility index of the Chicago Board Options Exchange. That spiked above 35 yesterday and then pulled back dramatically. Normally, that would be bullish, but we're not in normal times. We're in a war. And we're in a war with a country, Iran, who basically has nothing to lose at this point. And that's the big wild card here. Does Iran bomb the Aramco refining facility in Saudi Arabia? If they did that, and I'm not predicting that they will, we'd be in a situation that was worse than 1973-4 when there was a huge energy spike. And that makes $120 oil look cheap. Now, again, I'm not predicting any of those things are going to happen because I said in the beginning, predictions are tough, but you have to prepare your portfolio. A correction is not a reason to panic unless you go into a bear market. And then you really have to know that your portfolio is insulated. Uh, you don't want to go fully in cash because that never works, but you do have to prepare. And you're either preparing for a correction or a bear market. I don't know which yet, but you have to prepare. You have to put yourself in a position where you don't panic at the bottom, where you have enough cash that you feel comfortable and you're sleeping at night. And believe me, in a bear market, investors don't sleep well. I've lived through 9 of them, and I can tell you that they're not fun. And no matter how much you think you know about the market, bear markets are very humbling.
That is why we love having you on the show, Mark, is getting your 50 years of experience in Wall Street and sharing that with investors who might be new to the retail game and are just learning how to do this themselves and learning how to prepare for the bear market. It's not something we've seen too much of in the last couple of years. And so I think being ready for whatever this volatility in the geopolitical issues happening right now, but also in that presidential election cycle, are all good to pay attention to and be ready for. Before we get to that last piece of advice you have for investors, I do want to get your take. I think there's one thing that you said that stood out to me is that we're not in usual times. And so when it comes to that presidential election cycle, that is something that, has been pretty steady over the last every 4 years of that presidential election cycle. Is that still applying in a very different on not typical time, in a time when you have war and a time when you have many different things happening with leaders and politics that aren't really typical? Can you rely on that presidential election cycle data that we've seen in the past when things aren't typical?
I believe that you can, Bridget. And the reason is that events that we're seeing now are just magnifying the likely path of stock prices during the second year of a presidential term. That there's a logic to the presidential cycle. First year of a new president's term, there's a lot of optimism, enthusiasm, new policies are put into place. The second year of that term, those policies come home to roost. You see what the effect of tariffs are. You see what the effect of changing alliances with our European partners is. You see a president that feels emboldened to go to war. Typically, these things happen in that second year of a presidential cycle. You've got 2 more years to fix things if they break, and you've got the midterms to deal with where the party in power typically loses a lot of seats in the House of Representatives. So there's so many factors going on, and rather than try and super microanalyze them, the presidential cycle distills it all down to probabilities. Remember, there's a 70% probability based on the last 17 midterm election years that we'll have a correction averaging 14% in 2026. 12 out of the 17 last midterm election years have experienced a correction of between 10 and 20%. That's what we're suggesting that people protect themselves against because we're only down 2% in the S&P right now.
I love how looking at the numbers and just focusing on the data, the probability can help bring some ease and bring some peace to investors who might feel anxious, who might feel like these are uncertain times, unprecedented times, things like this have never happened before. But I love how you put that it does fall into a pattern, into a category, that if things like this are going to happen, they typically do happen in the second year of a presidential election cycle. So it's a great way to calm some fears and look at things from a probability standpoint, from a number standpoint. And that is what the Chaikin Power Gauge system is all about, is looking at the numbers, looking at the data and letting that guide your decisions rather than fear or emotions that so often play into the market. I also think that's why the power gauge is such a useful tool because it simply looks at the numbers and it looks at the data and it makes it simplified for investors to take away some of that emotional factors of the market. Again, you can check out the power gauge by scanning the QR code or clicking the link right in the description of this video. We'll also have a link or a comment pinned in the comment section too if you want to check out the Chaikin power gauge and have some numbers and data to help calm your fears during any kind of volatility we have ahead. I know, Mark, you have one more piece of advice, and this is important for investors to protect their investments during a potential bear market. What's that final piece of advice that investors should be doing right now?
Well, I'm going to end on a positive note. The expectation is that in a midterm election year, the market bottoms out in late September or early October. That is the best buying point of the whole 4-year election cycle. And the average gains off that low, particularly if you've been in a bear market, are north of 40% over the ensuing 15 months. That's why you need to have cash heading into the bottom that is inevitably going to happen in this 4-year election cycle, in this midterm election year. The buying opportunity is going to be there, but will you have the cash to take advantage of it, or will you be panicking at the low because you can't take the pressure on your portfolio? That's why it's so critical to prepare right now in case we unfold the way we're talking about, in case we get a correction or a bear market in 2026. You need cash to take advantage of the buying opportunities that are likely to be there in the fall of 2026.
That is a great bright side to end on, that even though the next 6 months or so might be a little volatile, maybe potentially dramatic, it might be a little bit of pain for your portfolio, that pain could pay off 14 to 15 months down the road after that September, October buying period. So that's something to prepare for. It's a prediction to look ahead to, and it's something to remember if we do hit that much deeper low in that September, October timeframe. Mark, thank you so much for the great advice for retail investors today. But if viewers are looking for some specific stocks to look at and those to avoid in this kind of market, make sure to watch Mark's latest interview from last month, where he shared 3 specific stock tickers he's bullish on, even in this market condition, and 3 names that he is avoiding right now. You can watch that interview here.